and welcome. I am Piers Ridyard, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I am joined by Barney Mannering, co-founder of Vega Protocol. Vega is a protocol for creating and trading margin finance products on a fully decentralized network. Originally listed on CoinList last year, raising over $45 million, with now over 21,000 token holders and now in the early days of launching their mainnet. Barney, great to have you on the show. Thank you so much for joining us.
Great to be here, Piers.
So, let's just start with the sort of the high level basics of what Vega is and what it's trying to do.
Awesome, yeah. So pretty worth going back to sort of a little bit of my history because that sort of explains it nicely. I'm a computer scientist originally, and I was super interested in the whole original crypto wars and crypto sort of revolution with cryptography rather than cryptocurrencies. And you still occasionally see the comments online about the hijacking of that term. But I got interested in that stuff back then. But after uni, I ended up actually going and working in sort of traditional finance in the city in London mostly. Spent just over a year in New York on Wall Street as well. Mostly working in sort of capital markets consultancy, technology consultancy, things like that. In that time, I designed and built and worked with people in the front office for a lot of different sort of major investment banks. Spent 2 years building and designing the core matching engine for the London Stock Exchange and did a whole bunch of things like that and got very close to traders and technologists in the city. And that was really what got me excited when crypto sort of jumped from just being Bitcoin, which was still exciting, but I couldn't see how I could get involved, to things like Ethereum and running software on chain. And I started to see all of these areas where I'd been frustrated with the slow movement, with the sort of gatekeeping, with the fact that there's no real innovation, and even fintech is kind of just messing around on the edges rather than really changing anything. And so I'd found that very frustrating and was actually thinking of a change of career, and I actually did a different startup for a year or so. And whilst doing that, we started thinking about what would decentralization mean for finance if you could kind of take that whole trade life cycle, take everything in finance and decentralize it and remove those gatekeepers and open it to innovation in the same way the internet had done for kind of communications and information. And that really got me excited. I invested in the Ethereum presale actually with some of the Bitcoin that I'd mined at that point, and ended up trying to look at how to do that on Ethereum and deciding it was just not possible. I decided it was too expensive, too slow. There was front running built in. There was just a whole bunch of reasons why Ethereum can be a settlement layer, can do a bunch of things, but it can't do derivatives and it can't do kind of most types of trading that you'd see in the city. It can do some things, but it's really not the ideal place for any of it, to be honest. So I kind of gave up for a little while, and then during sort of 2016, 2017, when things were heating up again, I met my co-founder Ramsey, and we started talking again about all these sort of things. And he knew some researchers at UCL who ended up founding Chainspace, which got acqui-hired by Facebook back a couple of years ago. And he introduced me to those guys, and we sat down and effectively said, well, okay, this is Barney's wish list. Can any decentralized blockchain system deliver that? And some things, when I said, can we get less than 10 millisecond latency? They were like, not really, if you want a global blockchain because of the speed of light and all those other pesky physical constants.
Right.
But we did end up sort of landing on something which we spent a few weeks sort of prototyping together, where we used Tendermint as a backend and started to see that a bunch of things could fit together, where I believed that it was possible to build a trading system that would be useful on a blockchain. And that was the whole thing for me. It was like, I've seen problems in the real world. I can see the kind of innovation that was good for information with the internet being good in finance. But if I don't think it can sort of reach a certain bar, then it's going to get laughed out of the room by anyone who needs to use those financial products for real purposes, and it's going to stay a toy. So I really wanted to be able to design something that, even if to start with it still had some toy-like features, had a path to being useful. And that was really the starting point for Vega and what caused us to get started back in 2018.
So what was that wish list?
Good question. There were a few things on there. So first one was around performance. So whilst I am a strong subscriber, there's a great paper by Chicago Booth University about sort of social uselessness of high frequency trading. So I'm a great believer that you don't actually need to make a trade in 1 millisecond. Information doesn't flow that fast. There's too much uncertainty. So I don't think you need a millisecond. But on the other hand, only being able to do 7 trades a second and having to wait a minute or 5 minutes or whatever for sort of confirmation, or 10 minutes for certainty, is probably too long, and probably actually is slower than finance needs to be. So part of the wish list was around speed and throughput, that you need to be able to have a certain level of speed to be useful financially. Part was around...
I have a couple of debating points for you on that, which I'd love to come back to.
Excellent. But... Very, very happy to talk about that. Another one of the things was around not being able to pay for front running, because like fundamentally, if everyone who wants to use your product is in a adversarial relationship with other people who just want to extract money from them, and the product makes that adversarial relationship easier, then that's actually worse than current finance, where at least you need a lot of money and a lot of a lot of effort to get a really small edge on things like HFT, whereas in blockchain, for a lot less effort, you can jump in front of people and make things really nasty. So that was another one. There was what I would call product parity as well, which is to say, like, for Uniswap or something, making a swap, that might be fine. A lot of the protocols that try and do things like options and swaps don't really look like options or swaps if you're someone who's trying to use those things to hedge some other exposure. And you need to have parity with the products that people would use, or in fact, ideally the internet and permissionless innovation enable a long tail of products where actually you have better products for a use case, not worse. So you need to have sophisticated products. Capital efficiency is another one. So particularly with derivatives.
When you say parity, could you just give an example of what you mean by the current suite of products not having parity?
Yeah, I'm trying to think. Back then, this was a while ago, and back then we were looking at the obvious examples were things like options products with limited downside or upside. So obviously, if you look at the payoff diagram for an option in a certain direction, it goes on forever. If you're locking money on chain, yeah, exactly that diagram. If you're locking money on chain and requiring it all to be done up front, then that diagram can't work. So you have to chop it off at a certain level. But for most of the use cases of options for hedging, that's really, really, really useless. So, it's not very helpful to say I've designed an options protocol with just this one change, because just this one change is a far worse product. And is actually, if you have a fast enough blockchain, you're able to run risk algorithms and whatever else, then there's no reason you can't have, unlimited upside or downside by having margins and maintaining them and having a system there. So, it can be solved. But product parity is basically saying having at least the feature set that people who want those products would expect. And for some products that's very easy, and for others it's more complicated. The next one is capital efficiency, which is super, super important. So, if you ever looked into stuff like synthetics, I'm not sure what their capital ratios are now, but when they sort of launched, it was like 7.5 times. So if you wanted to have
I think it still is.
Sorry?
Around that, yeah.
Yeah.
I think it still is around that, yeah.
Right. If you wanted to have a synthetic exposure to the price of Vodafone shares, you needed to put 7 times as much capital up as you would need to buy the shares. Now, that's worse than buying the shares, so why would you do that instead of buying the shares? But it's even worse for sort of hedging products. So like imagine that you were hedging, say some currency risk you have between the euro and GBP. And normally you're putting up 1% or 2% or 5% or something of collateral. If you're putting up 7 times the collateral, there's not much point doing the hedge. I mean, it gets to the point where it's not affordable. So really for the use cases of financial products, capital efficiency is very important.
I mean, like, I don't disagree with the point of capital efficiency being super important, though. Like with synthetics, like, to be fair, it's 7.5 times to create the underlying, but once the underlying has been created, then you can buy and sell it at the ticker price of that asset. And like, so you have in synthetics, you have 2 concepts, right? You have the asset creators who are able to create the assets against collateral that they post, but they're not actually paying for it. They're just posting collateral, creating the synthetic asset. And then there's a trading forum on synthetics that you then can buy and sell that asset. So if there is someone who's already created Vodafone and I want to buy, and let's say that they did an inverse Vodafone synthetic, so that if Vodafone goes up, that price goes down. If someone's already done that, decided they want to be the creator of that asset, I can go on Synthetics Exchange and buy the inverse Vodafone at at what I would expect it to cost, assuming, efficient capital markets here, but not necessarily always. But that's not saying that it's not capital inefficient. It's just saying that it's like slightly more complicated than I need 7.5 times to be able to buy an inverse.
Okay, so synthetics is not necessarily 7 times as capital efficient as holding the underlying. That's certainly true. The general case still holds for most, if not all, Ethereum-based protocols, though, which is that compared to the cost of taking out a margined derivatives product on a sort of traditional marketplace, it's horrendously capital inefficient. But that's good color around the sort of synthetics thing. If you're depending on whether you're sort of creating or buying something someone else created, that there's a difference for sure.
Right. Where every time I talk about this, I always feel like there's sort of like this haze of like almost separation of concerns that hasn't really been thought through in the same way that like the banking model thinks away. Like you said that if I draw an option from a really like simple point of view, it should have an unlimited upside. If I buy a call option at a certain strike price above that, it should have an unlimited upside. Actually, you are still limited by the capital adequacy of the company writing the option. And there is still like this concept of like capital adequacy for being able to write it and then having to hedge it according to your risk models and all that kind of stuff of the institution. And now we're moving to this concept of the smart contracts having capital adequacy. And I think that we started with a very simple model where it's like, well, for this particular object, I'm going to make sure there is enough capital for this particular object on Ledger, this particular product on Ledger. I think we are moving to this more like, what does the capital adequacy of the decentralized finance application look like? And then what is the capacity of it then to be able to write products against that? And it's going to start to iterate towards more the banking model that we're used to.
Absolutely. And really that, the point around the wish list was that if you like, as a decentralized protocol so if you think about the way that you acquire capital adequacy, usually is either by having a lot of capital yourself or by combining a lot of things to reduce risk. So, for example, if I'm in a marketplace with 10,000 other people, all have a variety of long and short positions and all have margin, then if I have a trade with you and you don't have any more margin and you start to reach your maintenance margin, the system, given appropriate level of performance, can close out the position that you have and can your position and take your margin away. But it can do that like contra someone else in the market, so that effectively my position stays whole. And as long as the risk management going on, the risk sort of calculations going on in the background there, understand the risk of that market well enough, and as long as there's a liquid market to close out, you can effectively design those things to provide the correct amount of buffer so that the capital adequacy of an individual participant doesn't matter. It's about the whole marketplace. And really when we looked at like at least the first iteration of Vega and the wish list, it was like, okay, well, how do we design something so that we can actually calculate as efficient as a blockchain will let us, given that, it is a blockchain, it has certain risks that people can run away and you can't send lawyers after them and all of that. Given all of those things, how much leverage, how much margin, how much efficiency can we actually get out of this system? And it turns out the answer is a lot. And one of the reasons the answer is a lot is because if your system does atomic closeouts and you don't do closeout auctions, which introduce a huge amount of risk, if you do atomic closeouts on chain, and if you're able to reevaluate positions once a block, and if your block has happened in less than 10 seconds, ideally less than 5, the amount of sort of leverage you can offer, because you can reevaluate someone's position really, really regularly, is actually quite high. So it's kind of interesting the sort of the fact that you have a zero recovery rate because you can never chase after them if they don't make good is kind of made up for by the fact that you can evaluate your position really often. So actually, when we looked at the maths, we found it actually worked out really nicely in favor of a kind of automated on-chain system as long as you have certain properties.
So what does atomic closeout mean?
So it means exactly what happens by default on every centralized exchange, which is like if you're on BitMEX and you take leverage, you have a margin level. If you don't have any more money and the position moves against you at a certain level, you will be closed out the second that move happens, and all of your money will be taken away from you. And that will happen instantly. As soon as a mark price is printed that should close you, that's going to happen. What happens on a lot of DeFi platforms, because doing that calculation is expensive, because it's a risk calculation. It involves recalculating everyone's position, checking if they need to be closed. What people tend to do as a shortcut on Ethereum-based protocols and others is they say to people in the marketplace, hey, if you notice someone whose position should be closed, you can basically claim some of their margin by closing it. You can effectively close them out. Now, this sort of works, but it introduces a delay. It introduces the opportunity for it to be gained by front running, and someone takes more of their margin. It's effectively then closeout auction. You bid for who's going to close it out at the sort of the most cheaply, and so or some variety of that. And so obviously, if you can front run that process on Ethereum by paying more gas, maybe you can close something out at a horrendous price or something like this. So there's a bunch of weird stuff that can be done, but in general, it just creates all of this risk around that closeout auction. What if there's no one who notices that someone is delinquent and needs to be closed out? So that adds risk, and that adds to capital inefficiency and all of that. Whereas atomic closeouts on Vega mean that the actual protocol itself, when a trade happens, it updates the mark price and it knows everyone's position and it knows whether they should be closed, and they will be closed by the protocol in the same way they would on a centralized exchange. It's just part of the on-chain calculation.
Interesting. So this is like the problems that have been seen. I mean, the main one that's had a real problem with that was MakerDAO, right, on Black Tuesday, when because of congestion on the Ethereum ledger and the time frame for the auction process to happen, you ended up getting this point where even though people would have actually paid a decent amount for the ETH that was on offer when the ETH price dropped, they couldn't get their bids in because of the congestion on Ledger. And so people were closed out on their CDPs, on their collateralized debt positions on MakerDAO at like pennies on the dollar, which also ended up costing the protocol as well.
This is exactly the issue. And there are kind of two related things here. One of them is the issues with having this process on chain for closeouts, so they're not atomic, which means there's all kinds of stuff that can happen. And the other one is around liquidity, and actually liquidity and sort of adverse market conditions. And in traditional markets, you tend to detect certain types of things, like potentially really low liquidity, certainly really large price moves that are abnormal. And you tend to do protective things. Like at the stock exchange, we used to do an auction. So effectively, you could enter a short auction and basically go, wow, that was a big price move. Let's leave the order on the book instead of executing it right now, and let's see if anyone else in the market has a more reasonable idea about the price. And effectively, if everyone sees an auction that's about to close at a 20% different price, often what they do is go, actually, I only think it's 5% different, and I'm willing at 20% different. That's a bargain. It's an arbitrage. I'm going to buy it. And so what you can find is if instead of a flash crash, instead of a big dump, or something that's been caused by one participant or making a fat-fingered error or whatever it is, causing a giant move, you end up having a pause in the market for 1 minute or 5 minutes or whatever. You end up collecting data about the real price from the market, and then when the auction closes, it does less silly stuff. And one of the weird things I've noticed is that no one in even centralized exchanges in crypto has worked out that this is a good idea yet. And so we kind of have these sort of the same thing happens in centralized exchanges, but actually Vega does have protective auctions, both for price and liquidity. So, in the case where there was insufficient liquidity to close out whatever was needed, or to operate the market would enter an auction until new liquidity providers had committed liquidity, and they're incentivized to do so. They can set the fee, they can receive rewards for committing that liquidity, and so effectively, the system rewards people for doing what it needs. And if it thinks that it can't operate a market that's safe and useful, it decides to operate an auction temporarily until the market gets back within parameters.
Got it. Okay. So, I mean, that actually that answers some of my questions about how you can do an atomic closeout in all conditions, because obviously there's some conditions where there isn't a taker on the other side.
Exactly.
And so then you have
the answer,
sort of like...
In the worst case, you end up in an auction sourcing the liquidity. And the auction does look a bit like a liquidity auction on another protocol, really. Ultimately, you have a period of time in which you're sourcing liquidity and for the other side. And if it turns out to be horrendous, you are going to eventually get a big price move. But if it, again, you can combine those things. So you have a liquidity auction or whatever, you're sourcing liquidity for the closeouts, you get the liquidity, but it makes a large price move. That would actually cause the auction to go into an auction extension because of the price monitoring, which would say, hey, we got the liquidity, but the price is big, so let's give the market a little bit more time to make sure we're still comfortable. So you can combine that, and all of this is configurable effectively by the market makers, by the community who create markets. So you can have a market that's configured with almost no auctions at all, with like complete craziness, no parameters, or you can create a market that's configured to be very conservative and have quite long auctions in order to make sure that prices are always, close to reality. And one of the fun things with doing this stuff at a community, instead of having some guys sat in a strategy office in an exchange, is that actually the community can innovate on this and can try different things and can work out where they land for each different type of market and product for the parameters for this stuff.
Really interesting. Okay, so we've got your sort of like wish list of speed, front running, resistance, product parity, and capital efficiency, which is a great like starting wish list. So, but I'd like to sort of now start to talk about the fact, you guys are your own blockchain, right? And so how did you guys come to the decision that building your own blockchain was necessary, and what are the design decisions that you've made in this blockchain that help with the speed problem, the front running problem, and the product and the product parity and capital efficiency problems, but like starting from the base and going up?
Yep. Yeah. So I think the first thing when we started, there was certainly fewer layer one options. So, one thing we didn't have was a large space of blockchains to work with. Tendermint was around. I'm not even sure if Cosmos had probably been announced at that point. But Tendermint was the most mature thing. We did think about
this
looking...
This was 2018?
2018, yeah.
2018.
Very beginning, end of 2017, beginning of 2018, we were looking at this. So the first thing that we realized was that there was quite a lot of stuff that was quite processor intensive, and that you didn't want to run on a kind of slow VM. Arguably now, maybe with things like Wasm and the optimizations you get there, you could probably use a Wasm type VM, but at the time there were no suitable VMs. Certainly the EVM wasn't suitable for doing this stuff. Another thing that we realized was that if part of controlling front running is our Wendy protocol, which is an actual protocol that prevents, that basically guarantees fairness under the same assumptions that you have a proof of stake chain working. But the other part of preventing front running and so
that's interesting. I'd love to go into that a little bit more. That sounds really
interesting. The other part of that is actually around fees, and fees come into two things. One is around kind of if you're incentivized to if you order the block based on fees as an incentive, that's not great. But the other side of it is uncertainty around the amount of fees is not good for trading. You should know what the fee will be for a given order roughly upfront, and it's quite uncertain at different points in time, but also not having fees related to the size of trades and things like that. So the other thing we realized, if we had a blockchain that was optimized entirely for trading, then it could do things like say fees are a percentage of the size of the trade, because everything has a size. You can't do that on Ethereum because not everything has a size. Ethereum's design is very good for what Ethereum is good for. The other thing that we realized when I thought about it was, there are many websites that you would just build on WordPress, right? And many applications, you build it on WordPress or on something, and off you go, and everyone uses the same basis. It doesn't matter if you're building a hotel booking system or a restaurant or your art gallery. You can just use WordPress and everything's fine and just get the plugins you need. No trading systems are based on WordPress. Every one of them is built specifically for trading, because time and performance and design are money in trading, and there's a lot of money moving around in trading. And so, as well as thinking we needed it for what we wanted to do, the thesis was, in the long term, if this is successful, the amount of money in trading means that the solution for trading will be blockchains that are only designed for trading, because being able to optimize when you're talking about the numbers that exist in trading, in fact, they even exist in crypto trading now, it's enough money that it's worth it doing properly. Being able to optimize every last bit, whether it's fees, whether it's execution speed, whether it's throughput, whether it's capital efficiency and risk models or whatever, being able to optimize all of that is worth it. And so having a conversation with a governance group where you're trading off between an NFT marketplace and someone doing on-chain ticketing and your trading, and maybe for trading you actually want a limited mempool and low latency and 2-second blocks or something, and maybe someone else doesn't want that. So you're always going to be fighting that, and you'll never get the optimization. So the realization we had as we went on was, not only did what we wanted to build suggest building our own thing, but in the long term, to be successful, everyone will end up with their own thing if they have a large enough trading platform eventually. That's kind of a theory that obviously needs testing, but I genuinely believe it to be true, especially with things like IBC. The final piece of the puzzle was the design, as you mentioned, design decisions. A lot of them were around, we will optimize for latency, we will optimize for trading use cases, we will build a lot of the sort of building blocks centrally. So instead of having, with a DeFi product that includes, say, like a DEX feature, everyone's got to rebuild the DEX, and everyone is going to do it slightly different and have their own potential opportunity to have bugs. Even if you fork Uniswap, your fork might be different, and maybe you're going to have more bugs. So one of the things we thought was like, the bit of Ethereum that we know works is the EVM, and everything you build on top of it is flaky. So if you move as much as you can into the chain, if every market has a nice configurable, flexible order book, AMM, risk calculator, closeout mechanism, if all those are available to everyone and everyone uses the same code, then it'll get tested much more quickly and it'll be much more reliable. And building a market will be about writing the code for your product and your specific market and your oracle, rather than writing the code for things that that should be reusable. So that was one design decision.
So how does that actually practically occur? Like, what is the difference between the deployment of a DEX on Vega versus the deployment of a DEX on Ethereum?
It's more that Vega is a blockchain that is a DEX. So you don't really deploy a DEX, you deploy a product, and you choose which features of the DEX to use.
Okay, so what? And if there isn't a feature that I want,
there isn't a feature that you want, then at the moment what you would do is you would get involved in the open source development process for the protocol. So the V2, the protocol is designed to be this kind of modular set of components that work together to allow trading of many types of things. The V2 of the protocol will bring in Wasm and will allow effectively deployment of new calculations and new modules at key points. So you've kind of got this framework for how things fit together, but you can say, okay, a risk model needs to be able to calculate risk given these inputs. I can deploy my own risk model compiled to Wasm, or a product needs to tell you how to value it given these inputs. I can create any product I like by filling in the valuation and providing any set of parameters that I want. And so, we're going to have the framework.
Just for the listeners' benefit, Wasm being the WebAssembly. I can't remember what S stands for. WebAssembly machine,
something machine.
But it's this new or not so new now compiler that allows you to compile down from a bunch of different languages. And so if you want to write in C, or you want to write in Rust, or you want to write in Java, but still run it on the same execution environment, you can do. And it's sort of become increasingly popular for layer one protocols to integrate it, right?
Yeah, and it started off on the web. So the idea was like, you can compile something down to Wasm, you can use it in a web page, and you get this kind of accelerated, fast. You can write C++ or Rust or whatever on the web, and that was seen as good. It originally compiled to an accelerated form of JavaScript, and then it got standardized. And I think one of the reasons why blockchains are taking it is the combination of the performance optimizations people have done in the VMs, the fact that you can use very standard programming languages, and the fact that because it's on the web, it's sandboxed. And if you're building a blockchain and you want people to be able to deploy a contract, you really don't want the contract to be able to, leap into a system call and delete everything on the disk of the validator node or something. So the sandboxing is really important.
Oh, so, that sounds fun.
It does sound fun, and I'm sure people will find some sandbox escape vulnerabilities in one of these at some point. But yeah, so the main point actually is not the technology we want to use, but once we've got the MVP out and we've got all of these different kind of modular things in place on the workflow, all these different parts of a DEX and derivatives products and settlement layer and everything else, once they're all in place, the V2 is, hey, you guys can all write your own modules that do each of these things, but they have very well-defined interfaces. So you kind of like, the number of places where you can shoot yourself in the foot is hopefully a lot lower.
And what is the profile of the people that you hope will be building on Vega?
Good question. And I think it changes over time. So right now, when we started, we had no idea if anyone wanted DeFi and DeFi derivatives. And it wasn't called DeFi, and it didn't have a name. And, there was like Ether Delta, and it was terrible because they hadn't worked out liquidity incentives, so all the markets were empty. They also hadn't worked out decentralization, so they got shut down for running a centralized order book. And, just Ether Delta proved that there was some demand somewhere, but it really was not the most amazing product at the time. And so we really weren't sure if anyone wanted this. And so we were trying to work out liquidity incentives, everything. The good thing is that people have demonstrated that they really, really want this, and there's loads of demand, which means that early on, what we're going to do is look for the people in the community who are interested in DeFi, who are interested in creating new products, in experimenting to get involved, and then the wider sort of crypto trading community. But in the long term, what we really want to see, and back to the original kind of founding vision, is we really want to see people use this for real stuff. When you look at how much small businesses and medium-sized businesses, but particularly small businesses and sole traders pay for things like hedging on derivatives when they interact with banks, it's kind of 25 times the realistic, reasonable cost. And so it's very, very easy to see how someone could build a simple hedging products, put them in front of a web front end. At this point in time, given the current state of sort of crypto in the world and regulation, someone building this would probably need to build a company and get FSA regulated or whatever, or SEC or whatever. But eventually, hopefully, that wouldn't be necessary. But it's possible to see that you could use this stuff to actually build a product, kind of like TransferWise did for transfers, to totally shake up some of these kind of small business derivatives and hedging market and say, here you go, here's a product direct to these people, but backed by markets that exist on Vega and the global pool of capital. So that's what I really want to see happen in the long term. But for the next year, really, it's kind of the DeFi crowd, the people in crypto who are into this stuff, and people who are kind of early adopters, because to get to that point where you can be putting stuff out there that sort of the more general public, if you like, in terms of businesses and individuals are using, you need to do a lot more testing and be live for a little while as an alpha and a beta, I think, first.
Okay, so like one of the things that sort of is a challenge for a new blockchain, a new layer one, and obviously Radix has similar challenges in this, is that you don't inherit the asset base that already exists, right? So like you don't have, if you build an application on Ethereum, you've got the billions of dollars worth of USDC and USDT and Ethereum and all that other stuff that already exists, that you can now just like relatively easily bring into your protocol if your protocol provides that, as in like your DeFi application. I really hate the fact that the DeFi industry now calls their applications protocols, because it's just like it messes with the terms. I'm just like, it's not a protocol, it's that. Anyway, the DeFi applications.
I find it particularly ironic that everyone calls their application a protocol, but then is actually sort of, there's no standardized protocol, there's no standardized interface for dealing with these things. Right. We call Vega a protocol because the idea was that we create a standardized interface for anyone deploying a derivatives market, and no matter what features they want, they get to deploy a market. And the key thing of Vega is it's not like if you create a market, there's upside there for you. Like we don't want, in the same way that if you deploy an ERC20 is kind of a protocol for tokens. If you deploy a token, there's upside for you if it's a successful project backing the token. Same should be true for markets on Vega. The whole point is that you own the outcomes of that, and the liquidity providers and creators own the markets. But yeah, so you're right. And actually, this is one of our very early design decisions, was I kind of said, look, I think I can design the best, or at least one of the best protocols for derivatives. I think we can design the network for it. I think we can do all of that. We can make something that's useful. But I don't think that we can create something. I mean, creating a token standard would be easy, but I don't think we can create something that will be attractive to people issuing tokens. And so sort of before we even started, we said we're not going to start with native assets at all. I mean, we do actually support native assets, but only if they're configured in when you start the node. In future, they may be enabled to support them, to creating them on Vega, but only if there's demand. So we said we're never going to support native assets at all. We're going to build bridges, and we're going to integrate with other chains. And Ethereum was the first bridge, and we're sort of so committed to that strategy that Vega is an ERC20 token. That means that the Vega network is live now, although you can't yet trade on it. So it's kind of going through this sort of launch phase where the validators launched the network a couple of months ago, and they're now sort of testing it out, bedding it in, and in the next 2 or 3 months, it will then go through to a network where people can actually start trading. But from day one, that network's been connected to Ethereum mainnet. So you stake your Vega tokens on the Ethereum mainnet, they appear, you receive rewards, you can withdraw them back to your Ethereum wallet. So all of that bridge stuff is there for Ethereum, and we're looking at things like IBC, integrating with things like Polkadot, Terra, even Bitcoin we're looking at. But Bitcoin bridges are probably the scariest and hardest and most expensive bridges to secure, and scariest to build. So they're probably going to be lower down the pecking order just for that reason. And there's already things like wrapped Bitcoin. But certainly we're looking at other bridges to do the kind of cross-chain thing. But I definitely looking at some of the other chains and things that have been created. And, obviously the challenges even for things like Radix, I'm pretty happy that we made that decision early on, because I think having access to the ecosystem of Ethereum tokens for people to trade will be really beneficial. And actually, the current fee situation on Ethereum is good for us in a way, like as in once we launch with,
Right.
we have derivatives and spot markets, and once you get things onto Vega, the fees are a fraction of a cent or whatever. That's going to be an interesting incentive for people actually to move their assets there and trade. So at the moment, that's looking
So,
like
so
a
the
good
bridge,
decision.
the bridge across to Vega is a trustless bridge of the type that you see between Avalanche and Ethereum, or between
I haven't looked at the details of the
Near and
Avalanche one,
Ethereum.
but I would imagine so. So it's trustless in that effectively there's a smart contract on Ethereum, and that smart contract is controlled by all of the Vega validators. So you pay into the smart contract. Now the Vega validators own your funds, and they credit you on the Vega network. When you want to withdraw, you ask the Vega validators to sign a withdrawal bundle, which you submit back to Ethereum to withdraw. At the moment, it's just a bundle of signatures. We have a working prototype of a ZK rollup version, which effectively allows many more validators without increasing the cost and a reduction in the gas.
Right.
So that'll be super cool. But yeah, the goal is to remain a trustless bridge that sort of only requires you to trust the validator of the Vega network, which you're going to trust to use it anyway.
Right. And what is the security profile of the Vega network? What's the underlying consensus, and how do you guys do security?
Yeah, so the consensus is Tendermint, which is pBFT, I think it uses. So the security profile is reasonably good. We use delegated proof of stake. The current network is a relatively small number of validators, which is probably the biggest weakness. We do have some like sort of anti-whaling stuff in the protocol, so effectively, there's a limit to the speed at which things can change. So if someone starts accruing stake or accruing stake as new validators trying to come in, they can't suddenly take over the network quickly. It's kind of a slow process. There's also the anti-whaling. So if one validator becomes too large, the rewards sort of decrease over time. So effectively, all of the people staking
anti-whaling. I've never heard that term. What an amazing term. So when you say relatively small number of validators, how many validators?
There's 13 right now. Before
13.
trading 13, yeah. So we are. That was kind of the launch set, and if you think about the way you kind of launch these things, there's no network of people to stake on originally. So we ran this process in the community to select the initial 13 and have a governance vote. We didn't. Well, if we make it more than 13, then this kind of slightly directed by Vega process, or where Vega's kind of helped out and where it's been in the community, that process ends up choosing everyone. So you kind of launch this network on 13, and then use governance to increase the number and allow people to join by staking and delegating. Right. So I'm hoping that we get a governance vote through in the time before trading actually begins on the network to increase that number, sort of at least sort of 25 or so. Obviously, the biggest downside of Tendermint is that large numbers of validators have a performance issue.
Sure, but you get latent. You increase latency and time of finality the more validators you add.
Exactly, and we're experimenting with how far we can go with that. Obviously, we have the sort of delegated proof of stake aspect to it. But yeah, generally, I'd like to see it sort of 25 to 30 before people are trading money, rather than just sort of getting the governance up and running. And then from there, obviously, the more the better in general. And we're looking into both ways to increase the validators, looking at some of the stuff that's going on in the Tendermint ecosystem, and some of the stuff that people like Sommelier and Mistron are doing, and as well as like how might we speed this stuff up or have more capacity in future, and also other things like how can you have kind of other ways of increasing security or decentralization. You can do things like offload security to another chain at checkpoints, so effectively people can't roll back past a checkpoint without messing with Ethereum or some other chain. You have other ways to get more validators involved in security. So there's a bunch of different stuff we're thinking about. It's something that over time, we know that what we have is probably good enough to launch into, like in the first couple of years in the sort of DeFi crypto community as a beta, good enough to get things going and to prove the demand and prove it works. But there's a lot of work to do, I think, between now and the kind of robust infrastructure that we want to see. but I think it's better to get something live and iterate it than spend forever solving problems.
Super interesting. So I think we've covered 3 of your 4 wish list points, sort of like in a good amount of detail. Speed, we obviously have a smaller validator set with a finality preferring consensus algorithm, which means that you get finality quickly and you're able to reduce latency to a certain point with, vary given the number of validators you have in the network. You have gone through very clearly the product parity, how you create standardization within your ecosystem of key components so that it makes it easier for you to have people issuing things that then are cross-compatible, and then capital efficiency by designing better sort of like products that are essentially take a lot of the learnings that you have from your background and within your community, I'm sure, of like the traditional financial products and how you can build better financial products as a starting point. However, you mentioned Wendy, and I'd love to go in the last 5 minutes to sort of just talk a little bit about how Wendy can actually prevent front running in your fee model.
Absolutely. So I'm going to say that if you want to know how it works, you're going to want to go and read some of the blog posts in the paper that Klaus wrote, because I'm not the expert on it, and we don't have time here to go through it anyway. But effectively, the idea is that at the time when you're doing consensus, what you're doing is you're trying to get consensus over what transactions you're going to sequence into a block and what order they're in. Now, usually what effectively happens is you have a round of voting where a block gets proposed somehow, usually from a individual node, but it can be other ways, and people effectively approve that they're okay with that block to happen. That's what happens in proof of stake and in proof of work. If you solve the puzzle, you generally get to propose the block and make it. So effectively, as the proposer, you get a choice of what's in the block. Effectively, what Wendy does is it adds a protocol on top of that, which runs sort of alongside the consensus algorithm, where a certain amount of information has to be known about each transaction in order to sequence it, and that information is information that's used to effectively run some rounds of this Wendy. So Wendy can sometimes, if not enough information is known about which of 2 transactions become first, can sometimes cause a transaction to not be sequenceable yet until another sort of Wendy round has happened. But what that means is that when a transaction is sequenced by Wendy, it means that it's assuming you're sort of 2/3 majority of honest validators, which you normally assume. It means that if the majority of honest validators saw my transaction before yours, as a result of the Wendy algorithm, my transaction will always be sequenced before yours in the block. And what that therefore means is that effectively, if I come along and start poking around in the mempool to look for stuff that has come before me that I'd like to go in front of, there's no way for me to get in front of that even by paying a validator, because the other validators won't accept the block unless it's gone through this Wendy protocol to ensure it can be sequenced in that order. So effectively, you add that on, and that allows you kind of a sort of a level of guarantee of the fairness of the ordering in a block. And apologies to Klaus that I probably butchered the explanation of kind of how that works, but at a high level, what it allows us to do is provide a certain amount of guarantee of fairness. And actually, the interesting thing in Klaus's paper is that you'll see there's a bunch of things that are impossible. And he's proved that there are certain levels of absolute guarantee of fairness that are impossible. Effectively, you can get to points where someone can, by doing certain things, force the network to have to take a random decision, but they do need a certain amount of control, and it would be kind of not worth it. But there are limits to how much you can do in a decentralized system like this. But what you can do is guarantee enough fairness that effectively the kind of front-running attacks that you see today and minor extractable value would not be possible.
Right, or at least severely curtailed.
Very severely curtailed. It might be some edge cases, like I said, because of those impossibility proofs. There might be areas that bump up against those where you can do something. Yeah.
Right. I mean, like in all these things, it's often not like an absolute you can stop. It's just you can significantly improve over current. And like one of the things that you guys are doing already is by reducing finality time, you significantly reduce the time in which people can even bother to do it in the first place. And then by adding, sort of like mempool ordering of events by sort of like some rough consensus mechanism prior to the actual consensus being used, you can then improve that fairness again. That's really interesting. What happens? We don't really have time for my last questions, but I was going to ask what happens when it gets congested, and what happens like then. But I think that We'll have to save that for another time. But it's been super, super interesting talking to you, Barney. Thank you so much for coming on the show. And thank you so much for sort of introducing all of the details behind Vega. If people want to find out more or get involved in your community, where's the best place to get started?
Our website, vega.xyz, or our Twitter @Vega Protocol are probably the two best places to get started. We also have a Discord that I highly recommend joining, that's linked from the website as well.
Awesome. Barney, thank you so much.
Thank you, Piers.